QuickBooks Online 2025, entering the estimate form. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for QuickBooks Online Test Drive, the free sample company file available to everybody looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. Choosing the United States version of the software, and we're going to verify that we are not a robot. Let's close that first tab because it is no longer needed. We're now in the sample company file, Craig's Design and Landscaping Services, opening up the major financial statement reports as we do every time. The reports on the left-hand side. In the favorites, we're going to be right-clicking on that balance sheet to open it in a new tab. Right-click on the profit and loss to open it in a new tab. Let's go to that middle tab, close up the hamburger, change the range. I'm going for a 2-year time frame, 01/01/24 tab, 12/31/25 tab, selecting the drop-down. I want to see the years so that when I run to refresh, I have 2024 and 2025 side by side. Let's go to the tab to the right and close up the ham boogie. Change the range to the same, 01/01/24 tab, 12/31/25 tab. We want to see it on the years, so when we run it, we see the side by side. And in 2025, nothing's currently in it except for that $34, including prior presentation transactions because we refreshed the browser, opened up an incognito window. If you're watching multiple presentations, I suggest you do the same so that we have as close to the same information as possible in the file. Let's go to that first tab. And now if we select the drop down, we've been looking at what we could call the customer cycle, the revenue cycle, the sales cycle, the accounts receivable cycle, where at some point within the cycle, we're hoping the cash will go up for goods and services that we provide to customers. We now want to look at the estimate form. The estimate form is a form that's a little bit unusual because it doesn't actually record a transaction. You will recall that all the other forms, for the most part, will be forms used not simply to give to other people, as might come to mind when you think of forms, but rather as a data input tool to record the journal entry into the system to make the end result financial statements. The estimate form is kind of a precursor form. We still track it within the system, but it doesn't actually record anything. To get a better idea of that, let's look at the flow chart. This is the desktop flow chart. We're in QuickBooks Online, but I'm just using the flow chart here because it has these nice little arrows and we can see where the estimate form is located. Remembering that if we're in the revenue cycle, it depends on what type of industry we are in as to how it will be set up. Are we in an industry like we're just getting paid from Google for YouTube, in which case we might just use a deposit form to record the revenue? Or are we at a cash register, in which case we might use the sales receipt to record the revenue? Or are we in a situation where we have to invoice the client, such as a law firm, a CPA firm, possibly landscaping, because we have to do the work first and then bill the client, tracking the accounts receivable, receiving the payment hopefully, and then making the deposit. It's usually in that latter format of company where we might also have an estimate, because you can imagine that one of the reasons you have to do the work first is because it might be a job cost type system. The work might be somewhat unique. In other words, if they're just buying a widget and all the widgets are the same, we can give them the widget at the point in time they make the order on a website or at the point in time they come into the shop. But if they want a custom widget, then we're going to have to make the widget in some way. And that means that we might also want to have an estimate, because the natural next question is going to be, well, how much is it going to cost you to make the widget? And we're going to have to say, well, I don't know, because it's a custom widget. And so that's going to apply to a law firm where oftentimes we're taking on jobs and we might have to make an estimate about them because everybody's case is somewhat unique. Same with possibly a CPA firm, tax preparation. In construction situations, you might have a similar kind of process where you're going to try to make the estimate as close to the actual bill as possible so that you can be upfront and honest with the customers. You might also use an estimate for situations where someone basically calls in to like a store and they're saying, hey, I would like a guitar or this kind of stuff that's in the shop. How much would it cost? Instead of the clerk pulling up an invoice, they can make an estimate form and say, okay, let me run an estimate for you. And possibly if they say, okay, that's great, I'm going to come in and buy that stuff, then you might say first, okay, if we want to hold on to it for you, you might have to give us a down payment. So we might use the estimate, for example, to calculate what the actual bill would be, get maybe a down payment, a prepayment on that amount, and that might be another way we use the estimate. So as you can see with the flow chart then, we're usually, if we have some kind of job cost system, we're going to make the estimate, and then we're going to do the work, and then invoice the client, and then receive payment, and then record the deposit. Now note that sometimes we think about those estimates with those longer jobs. Clearly, that's the first thing that comes to my mind is a construction type of company. If you have a very long job horizon, then it might take you years to complete the job, in which case you might have a different revenue recognition principle. In other words, normally on an accrual basis, we recognize revenue when we've actually completed the work. We've done the work, it's complete, we recognize revenue. But what if the job takes 5 years? Should I really wait until the end of 5 years before I recognize any revenue? That seems a little bit extreme in that case. So you might have different revenue recognition principles in a long job cost type of system, such as percentage of completion. So we have a whole nother course or section on that. That's a specialty field kind of in and of itself that I want to touch on to here, because the estimate will be critical with that kind of revenue recognition concept. All right, so let's just make an estimate. Let's see what it looks like. Let's get down to business. Let's just do it, man. Enough talk. All you do is talk, man. I hate talkers. All right, we're gonna do stuff. Here we go. We're in the customers. Let's make an estimate here. We're gonna make an estimate. So someone wants a job. Let's say they're gonna call in and they want to buy some inventory. We'll do the inventory so we get an idea of the inventory as it flows through with the estimate as well, which makes it a little bit more complex. Let's make this a good old customer number 1 tab, and we're gonna say let's save that. And then of course the estimate is a form that might go to an external user, and therefore it might be a form that you want to customize. Remember that when we think of forms, we're thinking about a data input form typically for our internal tracking purposes. Some of those forms being given to other people, such as customers and vendors, the estimate being one of them, and therefore we might want to email it to them. That would be the current way that you would most likely be delivering the forms in this new age time. Although emails are old, man. What are you talking about? Emails for ancient people. We got to give them I don't know, an instant message or something. Anyway, this is going to be, let's put this inventory item number 1 again. I'm just going to copy that and we're going to add the inventory item numero 1. We'll make it an inventory item, setting it up as we go. Let's put 10 of these on hand again, like we normally do. That will record a transaction for 10 units. Reorder point at 0, let's say. It's going to increase the asset account when we buy them, decrease the asset account when we sell them. We are doing neither here because it's an estimate form. Description, inventory item 1. Let's put the good old $100 for the sales price. It's going to sale of product income, but we're not selling it here. We're hoping to sell it. We're hoping this is the first step in the sales process, but the sale hasn't taken place yet. Let's say that we're going to apply tax to it when we sell it. So we'll have the sales tax we have to deal with, which is a type of consumption tax. And let's put the good old cost at 70 like we have been. And there's the cost of goods sold. Let's go ahead and save and close that. So we set up the item as we go. We have $100 and boom, bam, and there it is. So if they call in, we can say, okay, it's going to cost you notice it's calculating the sales tax for us. So it's going to cost you $108, including the sales tax. And so they can decide if they want to follow up on that particular job. Now, obviously, if it's a construction company, we might have multiple items. We might have a very long and complex estimate based on many different items that we're going to put into the estimate for being in the job of construction. But here we just want to put down the fundamentals of it's going to be an inventory item, so we'll make it a little bit more complex. So we have the similar kind of layout as with an invoice. We can add lines, we can clear all lines, we can message display in the statement, we can message display on the statement here, we can add an attachment if necessary. We can print preview. So if you look at the print preview, this is what it's going to look like when we email it to the client. This is a form we could customize. We have a whole nother course or section on customizing forms if you want to look at that, to put our logo on it and stuff like that. We can make it reoccurring. We can customize, and more options: copy, delete, audit history. So here's the transaction. It looks like it's going to record something similar to an invoice, remembering that the invoice would record, this will not, but the invoice would record an increase of 108 to the accounts receivable, increase of 100 to the revenue account for sales, the accounts or sales tax payable of the $8, it would decrease inventory by the $100, it would increase cost of goods sold by the $70, it would impact the subledgers for accounts receivable for customer number 1 and for inventory, tracking inventory by item. But this is going to do none of that because it's not an invoice, it's just an estimate. So we're going to have to track the estimate. So let's save it and close it. Now, one other thing we might say is, hey, we might have a policy to say, if you want us to hold on to that guitar, or if you want us to start this job, you have to pay us a down payment. So let's imagine that we say that the down payment is like, whatever, around 10%. Let's just say $10. We could say a percent that we're going to collect for the down payment, just to add that in. So I'm going to say, let's save it and close it. And let's say they want to lock it in. Now, if we have a down payment, that means that they're going to pay us before, this is back to our flow chart, we're going to get paid before we do the work. We're not yet invoiced them. We estimated, and then we jumped over to a payment before we did the work. So we're going to talk more about this prepayment situation later, because normally you would want that in a liability account called unearned revenue or something like that. But from a bookkeeping standpoint, it actually works quite well as a negative receivable because the subledger will be tracked in the same place. Again, we'll talk more about that later, but I just want to point that out now so we can touch in on it with this estimate form. So let's say that we're going to say, okay, based on that estimate, I'm going to record a receive payment form from customer number 1, customer numero uno, and we're going to say, and it says, hey, look, it doesn't have an open invoice. Normally, the receive payment form is going to be attached to an invoice, but we don't have one because I'm recording a credit to their account before we do the invoice, recording the payment before we actually do the work. So let's just imagine that we get a check. Let's say I'm not going to deal with undeposited funds, but put it directly into the checking account. And let's say that they gave us $10 just to put something in. And so there's nothing being checked off. So what's this going to do? The receive payment form decreases accounts receivable. That's what it does. That's what it's still going to do. However, it can't apply it to the subledger invoice, and therefore will make a negative accounts receivable, acting as though we owe the customer money, which we do. We owe them the $10 back, or we owe them the work to be done. So that should more properly be a liability, but again, it tracks beautifully in the subledger as a negative receivable. So let's go ahead and save and close that and check it out. You didn't select any invoices, save it as a credit. So it's a credit balance. I'm going to go into then the sales tab. Let's go into the customers. And then I can see in customer number 1, when the customer comes into the shop, let's close up the ham boogie. We can say, okay, we can see exactly what happened here, right? We can say, okay, here's the estimate. We have a pending estimate of 108. We save that, whatever, that landscaping item for you. And then we see that the payment has already been applied or already been made of $10, which we can then apply to the invoice that we will create. So let's, before we get into that, let's first go into the all sales items where we can track this information here. We could say, let's take a look at the estimate. This is one place where we might sort the estimates, although more likely we have a nice estimates tab over here, so we can do it there. So this is another area we can see the pending estimate, and we can edit it, we can send it, we can mark as accepted, view, duplicate, share, and so on, and make it to a purchase order. If we need to buy the inventory, we might use the estimate to then create the purchase order to buy the inventory. But more likely we're going to make an invoice with it. And then we've got the statuses, we have the pending, accept, open, close, converted. So clearly when you have an estimate, then what's going to happen in the future is possibly the person comes in and takes us up on the estimate, at which point we might make a invoice from it, at which point it would move from open to closed, or maybe they don't take us up on it and we basically close it out ourselves. We might call it declined. So it will depend on the type of business in terms of how many different categories of estimates you want. At the minimum, we're going to want an open estimate and then estimates that have been closed or declined. But we might have an accepted estimate. So if we're in a job cost system, we might want to say that it's been accepted, but we haven't created an invoice with it yet because we still have to basically do the work. So you might have a system where it says we have the invoice has been given, it has been accepted. That would mean they accepted the job, and then we're basically going to do the work. And then at the end of the time we do the work, we're gonna close the invoice or close the estimate when we enter the invoice. We have the open item if it's an open estimate, and so on and so forth. So there's going to be the estimate. We can also sort this by the what else? The sales receipt. So here's the sales receipts that we had, and we have actually no. I'm looking for the received payment. So we have the sales receipt. We've got the money received. And there's customer number 1 where we received that $10. We could also go to the estimates here. So in the estimates tab, probably the place we would go, of course, to sort the estimate, where once again, we have the status drop down, pending, declined, accepted, and so on and so forth. We have our item here, which is labeled as pending by default when we create the estimate. Okay, and then let's also go up top and say we got that prepayment. What does that mean? Well, let's run this thing and say we put the prepayment into the checking account. Let's go into the checking account and check out the check-in. There's the $10 payment that we received. The other side is going to accounts receivable, but it hasn't been assigned to an invoice. So we're going to go back on over and say, okay, accounts receivable is the other side. Nothing's happening to the income statement, even though we got cash because we didn't do the work yet under an accrual method. There's the payment. Let's go back up, and then let's go to the first tab, and we know in the subledger, which I can look at by customer, it's in customer number 1, which is in essence our subledger. So there we have it. So now we have this negative amount. Let's also look at the report just to show you an actual subledger report. Go into the reports on the left, and then I'm going to go down to who owes you, and I want to go into a customer balance detail report. Open in a new tab, and I'll close the ham boogie and all dates. So there we have it. So this is giving us all the information by customer, and you'll note that customer number 1 here has a negative amount. That's the problem, because it really should be a positive liability. So how we'll talk about dealing with this when we talk about prepayments later is, in practice, oftentimes, if you have to do external reporting at the end of the year, which you might not need to do if you're just doing this for taxes, because you only possibly need the income statement for income tax purposes, then you don't really have, then that will be fine because it works well for bookkeeping. But if you have to report the balance sheet on the income taxes or for external reporting, we might do an adjusting entry if this was still outstanding, increasing the accounts receivable and recording it to the proper liability account. So that would work well, because that means that we can do from the bookkeeping standpoint the easiest thing, and then we can make a periodic adjustment for external reporting purposes to properly break out the accounts receivable versus the liability of something like unearned revenue. Okay, but the total down here of the 527,152 should tie out to what's on the balance sheet in accounts receivable, 527,152. Okay, let's go to the first tab. Let's go back into the sales. Let's go into the customers, customer numero uno. And we're going to say that we have our estimate. And within the estimate, we can, let's actually go into it here. I'm going to edit it. And then within the estimate, we have create invoice. So let's go ahead and, or we can copy it to a purchase order in here. I'm going to create an invoice. So now it looks a lot like the estimate, but now it's in the invoice. So we're going to say there's customer one. If we wanted to email it, we'd have the email, boom, 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 boom. So now they're in the shop, or we're actually going to ship them the guitar or whatever, or the landscaping work. And now it's actually going to record it. So now the invoice will actually record the increase to accounts receivable of the 108, the increase to the revenue account of the 100, the increase to the sales tax payable of 8, the decrease to inventory of 70 driven by the item, the increase in the cost of goods sold of 70, net increase to net income 100 minus cost of goods sold of 70, and the subledger for the customer number 1 and subledger for inventory item. So let's, and it will create, the estimate should now be converted to something like closed or completed. So let's go ahead and save and send it. Save and close. I'm not going to send it, obviously. I don't even have an email address. What are you even talking about? So there's our invoice. And it's been, now notice what it did is it applied out the payment to it. And it did it automatically again because the system saw that there was an outstanding balance for the customer, and it automatically applied out the payment. So let me see what happened. If I go into the payment now says closed. Let's go ahead and edit it and see what happened. Now it automatically applied it to the invoice. So that's great. So it applied it, and if I link on that, it'll link to the invoice. And now I can go back into the invoice as well and edit the invoice. And we'll note that at the bottom, the payment has already been applied. Again, we'll talk more about this later with this prepayment situation, but just realize that this bit down here didn't record anything new. It still recorded 108 as revenue, 108 in accounts receivable. It's just that this $10 had already been in accounts receivable applied to this customer, and for informational purposes, so that of course the customer knows how much to pay us, it added this little bit to the bottom of the invoice. And that's typically how you would have to do the invoice if you do this kind of prepayment situation and you use this method. You would have to make the invoice, record it, and then let the system or apply out yourself the credit balance to it, and then go back into the invoice, and you can print it out at that point and send it, which will have the correct balance at the bottom of it. And now the estimate has been changed to converted. So now if I edit it and just take a look at it, the estimate has now been changed in status to closed over here. So that is great. So if I was to sort the estimates over here in the estimates area, then this estimate has now been converted. So it would no longer be in the open or pending status, and that has been closed. What has been recorded now, if I go into the balance sheet, the invoice has been recorded, which is our standard. I'll do this fairly fast because we've seen it before, but I do want to touch on that subledger, which should be fixed now. So if I go into it, there's the 108, the 10 that had been recorded with the payment. So the 108 has an other side of it on the income statement. If I run the income statement, there's the 100. The other side, the difference, the $8 back on the balance sheet in a payable account. For the Board of Equalization, I'm losing my voice here. That's not good. Don't go, voice. I need you. I need you. It's busy season. You can't abandon me during busy season. All right, we're going to go up top, and we're going to say then inventory. If I go into inventory, we know that the inventory is impacted here with the invoice going down. And let's go back, and then on the cost of goods sold, we know that the inventory is impacted here. Net impact on net income, 100 income minus the $70. Now, also, if I go to the balance sheet, this accounts receivable should tie out to the subledger. Let's go to the subledger on the right. And now, of course, we don't have that problem because customer one has the invoice basically outstanding, and this is the amount of the invoice that's still outstanding. In other words, we don't have a negative accounts receivable for a particular customer, which should be a liability. So note that that problem with the negative receivable with a prepayment is only a timing difference. It's only a problem until you actually get paid or issue the invoice. And so we'll talk more about that when we get to the prepayment situation. But that's the general idea with the estimate. Once again, you're only going to really see that estimate form for like companies usually that are invoicing people and customers that have like a job cost system, typically where you're going to need to run an estimate. Although again, you might use that estimate form in a store or something if someone calls in and wanted you to calculate the sales tax possibly included in some kind of item or whatnot.